time is 6:17, and it's time to look at your money. For much of the past 2 years, rising interest rates have posed significant challenges for both consumers and businesses. Interest rates on many credit cards, bank loans, auto loans, and home mortgages quickly soared to 40-year highs. But with the growing uncertainty over the state of the U.S. economy, when can we expect interest rates to finally start declining? Financial advisor Mark Grevacheski joining us now over Zoom to break down this for us. Good morning, Mark.
Morning, Devin. Good to see you again.
So let's get right to this. What's the process for lowering interest rates, and how does that happen?
The Federal Reserve manipulates what's called the Fed funds rate. Now, the Fed funds rate typically serves as a basis for, many types of consumer debt. And as the Fed funds rate is either raised or lowered, you'll see interest rates on credit cards, auto loans, bank loans, home mortgages, and many other types of consumer and business debt also rise and fall accordingly. Now, over the past 2 years, the Fed raised the Fed funds rate to a 40-year high. And the goal was to slow down consumer and business spending by making it more expensive to borrow money. You're now going to be charged a much, much higher interest rate. And a slower pace of spending would help tap the brakes on some of those inflationary pressures. But with this concern of a severely weakening economy in the second half of the year, the Fed is expected to start lowering that Fed funds rate, and this should start to lower interest rates on all those various types of consumer and business debt. And the goal is to try to ease some of that financial burden on consumers, on businesses, and to try to limit the severity of any economic decline.
So when and how fast do you expect the Federal Reserve to start lowering interest rates?
Well, my crystal ball is still in the shop, but this is kind of what the general consensus of Wall Street is. Most likely, Devin, the Fed's first rate reduction will be at its next scheduled meeting on September 18th. But the big unknowns are, first, how aggressive will the Fed lower the Fed funds rate at that September meeting? Will it be a minor rate reduction? Will it be a much larger rate reduction? And second, to what extent will the Fed further lower the Fed funds rate at its following November and December meetings? Remember, the Fed will not hold any meetings in October. Because of this sudden concern over the economy we've now seen pop up, Wall Street expects the Fed to aggressively reduce that Fed funds rate at all three meetings in September, November, and December. But in the meantime, the Fed will be closely watching inflation, the labor market, consumer spending, business spending, and a host of other economic data to try to provide some type of clarity on just how severe any economic weakness in the second half of the year will be. And one of those key pieces of data, Devin, will be the July Consumer Price Index released this Wednesday morning. So if it looks like the economy is heading for a recession, the Fed will likely ramp up that speed and aggressiveness in lowering interest rates.
So when might we expect to see lower interest rates on some types of consumer debt, such as credit cards or home mortgages?
Yeah, a lot of people are looking for some type of relief in lower rates. But look, on some types of debt, such as home mortgages, we're already starting to see some lower rates being offered in anticipation of the Federal Reserve starting to lower the Fed funds rate. But other types of debt, such as credit cards, for example, are typically slower to respond and might not start to decline until the Fed actually starts to lower that Fed funds rate at its September meeting.
All right, Mark, we know that you will stay on top of this and we'll continue to provide updates. Thank you so much, and we'll see you next week.
See you next Monday, Devin.
All right.